Stocks trade in a band ahead of US CPI print later today and the Independence Day holiday tomorrow. Ahead of two expiries, the Nifty and the Nifty Bank. It's the IT stocks that eke out gains, but industrials and power are the big drags. The mid-caps underperform.
The Supreme Court allows state governments to collect past dues on mining from April 2005 in the form of royalty and tax. It, however, directs states not to levy interest or penalty on the past dues and collect them in a staggered manner over 12 years. This move can be a big blow for miners.
Hero MotoCorp skids after high material costs dent margins, even as demand outlook remains positive. But Apollo Hospitals rises despite an in-line performance on the promise of improved margins going ahead.
Vedanta is looking to sell 11 crore shares or 2.6% of its near 65% stake in Hindustan Zinc via an offer for sale. Transaction can fetch Vedanta over 6,000 crores, which shareholders expect will translate into a hefty dividend.
The Enforcement Directorate quizzed Mohit Burman last week and recorded his statements on alleged money laundering in the Religare Enterprises open offer matter. The development casts a shadow on the proposed offer.
Hello and welcome to Halftime Report. I'm Ekta Batra and with me is Manglam Malu. Well, it's turning out to be a session where we're seeing consolidation in the frontliners, the mid-caps underperforming at this point in time. And on a week-to-date basis, at current reckoning, it seems as though the mid-caps will continue to underperform. At current reckoning, we're sitting with a cut of around 1.3% on a week-to-date basis. Nifty down around 1%. But we do have the WPI data for the month of July on your screen at 2.04%. We have Lata in the studio to take us through the key highlights there. Lata.
Thanks for that. The WPI headline inflation actually has come in a little lower than our poll. Our poll was 2.1. It's come in at 2.04. And it's also lower than the WPI, the wholesale price index that came in last month for June, which was 3.36. Now, just a word about the background. All of last year, up until November, the WPI was negative. It was negative because a year ago it was very high because of the Ukraine war, with so many, everything from iron ore to edible oils shooting up. That made it negative. Now we are normalizing. And as we normalize, you are getting a small positive number. This will continue for some time. After that, we can see a sharper rise, perhaps, as we go towards the end of the year. But the 2.04 is still a good number because it's lower than the poll and lower than the June WPI. But the details, some of them are looking a little disturbing, with potatoes, onions, and such other inflation numbers still coming in a little higher. Let me get to the expert immediately. We have joined by Aditi Nair, the chief economist at ICRA. Aditi, what have you made of the overall number? You think the WPI inflation will now start a slowing? I mean, it won't rise because of what? Chinese disinflation and such other factors?
Thanks, Lata. So today's number is a tad below our expectation as well. We had penciled in 2.1%, as you just said, for your poll. And the reason for the month-on-month deceleration is primarily the base effect related to food prices, just as we had discussed for the CPI. But also what's turning out in July, August are some other global factors that are possibly going to lead to lower uptick in the WPI going ahead after the base effect unwinds. So we've had crude oil prices softening, we've had commodity prices softening over the last couple of weeks, although the INR has depreciated relative to the USD. So we'll have to see how these factors play out over the next couple of months. As of now, we were looking at the WPI averaging just a little over 3% for the full year. And rising, post the base effect normalization to a range of 4 to 5% in some of the months, particularly in Q4.
But Aditi, the bigger thing I wanted to ask you is, are we going to undershoot the Reserve Bank's forecast even on CPI? The CPI number for July also came in at, 4.54. The expectation was that it would, 3.54. The expectation was it will come closer to 3.7. And now the food index is up just about 2.7 on the month. If you compare July food inflation, it is 3. I'm now looking at WPI. at 3.5% compared to 8.6 in the month of June. Manufacturing products index month on month is down 0.1%. So, fuel, manufacturing, food, all three are down month on month. And the CPI also undershot. Are we headed for a lower than expected CPI for the full year as well?
For Q2, we think so, but not necessarily for the full year for the CPI as compared to the RBI and the MPC's forecast. So we do think that Q2 there will be at least a 20 basis points undershoot as compared to the MPC's latest estimate. But for the full year, we're still around 4.5%. The disaggregated trends for food prices are actually quite mixed in this month when we look at the data that we have on the high frequency food prices. And overall, vegetables, of course, tend to be highly volatile. So we'll have to see how those settle down. And monsoon is now above normal. Let's see if there are periods of disruptive rainfall going ahead, or if the rest of the monsoon season is quite well distributed and fairly favorably distributed to, let us end up the season with the Kharif output being on the higher side, which should be good for prices going ahead. But as of now,
so anything stand out for you? Anything stand out for you in terms of EBITDA margins of corporates because of the falling manufacturing index? Should we expect anything positive for the for corporates, or even negative? If their final products are going to see lower prices? And separately, will you advance the Reserve Bank rate cut expectation?
So on the EBITDA margins, we thought they would be less supportive to the overall GDP growth trend for Q1. For Q2 and Q3, possibly, this will be a bit of a tailwind. Let's see again if it sustains. And Q3, what we're hopeful of is that after the Kharif cash flows come into the farm pockets, if the cash flows are favorable, then there could certainly be pent-up demand that pushes up rural consumption during the festive season. So we could end up with a very positive mix of factors in Q3 that could really push up the Q3 GDP growth.
Okay. All right. So maybe you are counting our chickens too quick, counting the eggs too quickly. Thanks a lot, Aditi Nair, for joining us. The basic message is, like the CPI, the WPI, Wholesale Price Index, is also a little lower than what the market is expecting, and very importantly, much lower than what was June inflation in both in food, fuel, and in manufacturing products, which is an important input when we analyze corporate EBITDA and EBITDA margins in coming quarters.
Okay, all right. So maybe a positive lagged effect is what we could expect, Lata, from that. Thanks very much for joining in and taking us through that. We'll take a short break, but up next we'll be talking to the management of Aurobindo Pharma on their Q1 FY24 numbers. Stay tuned.
Welcome back. You're watching us here on Halftime Report. If you missed the opening of the market from yesterday's close, you haven't missed much, at least on the Nifty and the Sensex, but your portfolio would be feeling a deep shade of red because of the big gash that we're seeing in the mid-cap end of things. The index down almost 0.6% right now. Though for the frontline indices, we are seeing some bit of recovery from the lows. Let's talk about Aurobindo Pharma then. The company reported an inline set of numbers. Their margins expanded and drug sales also grew by about 14% on the year, although their US business performance missed street expectations by a slight bit. Ekta, my co-anchor, spoke with the management on their first quarter performance, began by asking them about just that, the US sales and the outlook going forward.
This quarter, US revenue got impacted by the non-seasonality. As you are aware, that we have a good market share in the antibiotics, and this is not a season. And yet there is a drop in that. Apart from that, as we explained in the earnings call also, because of the remediation action was going on, and because of that, the related production delays have taken place, and because the specialty and injectable performance has come down because of that, which is expected to be resolved in the coming quarter, because we are already started seeing an improved production in this quarter. So this is expected to improve upon it. These are all the two major reasons. And the next season, the next quarter, that is the July to September, should be a good one compared to April to March, April to June.
So what are you targeting in terms of quarterly sales from the US going forward, given the contribution from Revlimid?
As you are aware, we are not giving the specific number on the Revlimid. So this is not, we are not disclosing that.
Okay, but are we working with around $425 million in terms of a quarterly run rate for coming quarters in the US? Or are you probably going to inch up similar to, say, for $40 million?
No, we are certainly going to inch up coming quarter, but we are not specifically telling whether it is a $40 million like that.
A ballpark range?
I think we are not giving any specific number, Ekta. Right?
Okay. Well, on consolidated markets, on a consolidated basis, rather, your EBITDA margin guidance is around 21 to 22% for FY25. You've, as of now, not factored in any improvement in margins due to the PenG project. And you've mentioned that you will reassess your margins in November of 2024. Any outlook that you can provide us in terms of what we can expect on the margin picture now, as well as going forward?
You're absolutely right. We are not factored in anything on account of the PenG right now. We are in the process of progressing, and we are now taking higher commercial batches. These commercial batches will come around 30 batches we expect in the month of September, which will help us to give a meaningful contribution to the system. That time we can assess how much improvement will take place in the overall gross margin.
Okay. Well, coming to Eugia now, you are estimating around $600 million of sales in FY25. Where is this pickup expected to come from, considering that Unit 3 as well as Unit 2 are under the regulatory scanner?
The regulatory scanner, as you are aware, we have been now classified as OAI. OAI is not going to stop any dispatches or improve production. So obviously we will be able to achieve it, and also we are working on the other markets like Europe and other places. So the business team is pretty confident they will be able to achieve the 600 million mark.
Okay. Now, Unit 3, you had indicated that there was some spillover of remediation costs into Q1 from Q4 as well. Is that now complete, or can we expect further spillovers into Q2?
No, we have already said, no, from Q1 to Q2, the spillover 7 million has come down to 2 million. This quarter is expected to be 2 million. We have already communicated. No?
Okay. So what is the overall status of remediation for Unit 3?
I think they have done all the CAPA, they have done most of the CAPA, everything, and they have already done the entire quality checking, everything. And they are also putting new process. And this is going to benefit the business. And we are pretty confident about it.
And Unit 2, which just received an OAI?
As explained, no, Unit 2, there are not major issues. There is a particular product, whether it tantamount to contamination. I think Dr. Satkarni can be able to throw some light.
Okay. Well, Dr. Makapati, what about the remediation? Are we expecting a possible reinspection of these two facilities soon?
I think the remediation efforts are going on well. We believe that once the CAPA responses have been submitted, everything will be back to normal. About the inspection, etc., it will be speculating right now, but we are confident based on the nature of the observations. We are confident that we will tide over with the CAPA responses that the units will submit, the unit quality teams will submit.
Okay. And what about fundraising? You all did mention that, IPO plans could be on the cards, Mr. Subramanian, when it comes to Eugia. Can you apprise us of where the plans stand?
No, we are discussing with the bankers, and we need to get a clear opinion. We can go ahead with that or not. And after that, we'll go to the board with their recommendation. And after that, only a clear decision can be taken.
Okay.
Till the time, everything is a speculation.
Okay. As of now, there's nothing concrete when it comes to UGR fundraising.
As the company, we have been exploring various options, etc., as you are fully aware, and we are doing that only.
Okay. Well, Dr. Makapati, what is the status of the tie-up with regards to MSD? The status of the facility that you have to be building, and when can we see revenue starting to accrue?
So, Ekta, the last time we spoke, I mentioned to you that we have just signed the definitive agreement with MSD Singapore entity that includes one product schedule for manufacturing. Now, I also told you that with the limited letter of intent that we signed last year, we have initiated the civil works of the facility not to lose time. Now, having said that, the signing of the definitive agreement made sure that we could progress on the civil works with much more conviction. So the project is shaping well. I am quietly confident that we would be able to complete the commissioning of the large drug substance facility that comprises of 15 KL bioreactors, mammalian, and the drug product facility with the associated QC laboratories. All of it, I'm confident of commissioning by 2026. And we would also be initiating the engineering runs followed by the validation batches soon towards the end of 26 and early 27. So to your second question about when would I expect the revenues to come in from Theranim Biologics, the CMO business of ours, I expect the revenues to trickle in based on the milestones that we achieve, which is essentially the validation batches and the stockpiling effort that will start. I expect it to come from 2027 onwards. But the inflection point in terms of revenues for Theranim would be from 2029.
Okay. Any more such tie-ups, Dr. Makapati, that we can expect? This is for one biologic product to start with. Do we see an extension beyond one product? And also any other companies that you would probably look to become a CDMO manufacturer when it comes to biologics? And when can we expect any kind of firm timelines?
I think that's a pretty good question. With Theranim Biologics, at this point of time, I would like to focus my initiatives for Aurobindo and for biologics around the anchor industry, which is the MSD. So at Theranim, I would not expect any more tie-ups for the first few years. We would like to deliver at Theranim for our first customer, and going forward, depending on how this business shapes up, there is always an opportunity to scale up the business in the CMO segment. Now, with respect to the other subsidiary or the affiliate that we have, which is focusing on biosimilars, which is CuraTech Biologics, this is where I expect some traction in the next couple of years, where we would be actively engaging in some contract development opportunities as well with the innovative companies.
Right, interesting conversation there with the management of Aurobindo Pharma. A few probing questions, the management's refusal to answer them. Obviously, we'll get answers to all of that, Ekta, as and when things develop out there, but we'll try our best.
Yes, absolutely. Just to get that quarterly figure in terms of US sales, considering that they have big products such as Revlimid generic contributing. But nonetheless, they said that there could be some improvement going forward.
Right, we take a short break, come back on the other side. Let's see whether there would be things improving for Ease My Trip or not. Their first quarter performance, we'll discuss that in detail with Prashant Pitti. Welcome back. The IT stocks are supporting the Nifty from the way down. In fact, Infosys and TCS have moved to the high point of trade. The IT index comes up for you. That tells you the story of the day, where there is a bit of a tug of war between bulls and bears. Right now, it is being supported from the IT sector for the bulls itself. Let's talk about Ease My Trip. Now, it was a steady quarter. Revenue growth came in on account of the hotel business, which showed a strong growth in both earnings as well, revenues as well as the operational performance. The stock is slightly under pressure, maybe because the street would have liked the air passage business to grow a lot faster as well. So to discuss this and more, we have with us Prashant Pitti, who's the co-founder at Ease My Trip. Prashant, While overall reported numbers are pretty strong, the air passage business, it seems like for the last 3 or 4 quarters, the reported growth has been below what the industry has been growing at. So just wanted to understand what explains this and what your targets out here are.
Well, thank you firstly for having us on the show, Manglu. Basically, as you can see in the last particular quarter, we have focused a lot on the bottom line, and the company's PAT, which has come to about 34 odd crores, have increased significantly when you compare year on year, even though the GBR, the gross booking revenue, might be the same. So we have been saying this for the last 1 odd years, that the company is more focused on the bottom line, not on the top line. Besides, the company is also focused on growing the non-air space and also international expansion. And the results are in the viewing. You can see our Middle East business grew by a whopping 140% when you compare year on year. And in the last year, we did total in the last quarter, we did total business of about 126 crores just from the Middle East.
Yeah, but that's on a low base, Prashant. We understand all those parts of the business which are doing extremely well. The point was that at what rate are you expecting your air passage business to grow this year?
See, if you say that last year, last to last year, our cash flow was negative. But in the last year, we turned it around. And from negative cash flow, we have made it about 120 odd crores positive cash flow. So now we believe the time has come for us to catch up on the GMV again for the airspace. Eastbat Trip has done this multiple times over the period of last 16 years, where we have categorically focused on one particular thing in one particular year. So for the last year, the focus was on the bottom line. But going forward onwards, we can expect us to catch up on the GMV.
And what would that mean in terms of numbers?
It would be hard for me to say those numbers right now, but in the next quarter results, we probably will give some guidance.
Okay. All right. When you spoke about cash flow, 120 crores positive in FY24, what are you envisaging, or what's your guidance for FY25? And what are you probably making? Yeah.
So the idea is to continue to be cash flow positive along with being profitable. And this year as well, we anticipate the same thing. However, few key highlights I would like to share for this particular year is the focus on the GMV again, along with maintaining the strong profitability and also growth in our hotel and holiday space. As you could see in the last quarter, we grew our hotel and holiday space by about 120 odd percent, 117 odd percent. We would want to continue focusing on hotel and holiday space and also the international expansion for this particular year.
Okay, all right. But are you giving us a number for the cash flow? 120 crores goes to what figure?
That I don't think so I'll be in position to provide at this moment.
Okay. I just wanted to get a sense in terms of, what we are expecting when it comes to the hotel segment this time round. There was some amount of strong growth that you saw there. You did around 27 odd crores, 27 and a half odd crores. Give us a sense in terms of what we are expecting when it comes to revenue growth there. How much is it as a percentage of sales? How much do you want it to rise to? And these 18.5% EBIT margins go to what level?
So current EBIT margin for our hotel and holiday space is actually in a good space of about 18.5%. I believe that we would want to continue with this similar EBIT margin. One thing which we are looking forward is to make at the time of listing, 97% of our business was flight business, and now it has come to 88 or 89%. So we look forward to continue with this trend, and in the next couple of years, we would want our non-air versus air to become 25-75, 25% to be non-air and 75% to be air. And something similar is what we are looking for India versus non-India business as well, which is business originated by Indians versus non-Indians.
So what does that number stand at? Because, your Dubai business has done extremely well. Your office, you were talking about that earlier. And if you look at the first quarter itself, the gross booking revenue has been 127 crores, which is 50% of what you did in all of last year. What are you expecting here?
So as I said that, to provide exact guidance for this year would not be possible at this moment. However, the next quarter results, we surely will be able to provide some guidance. However, for the next couple of years, as I said, that we would want 75% of the business to come from India and 25% of our business to come from outside India.
Okay, we're not asking you for forward-looking statements, but currently, what exactly is your market share? Because the last 3-4 quarters, because of your focus towards cash flow, your air business revenue was below what the market was. So have you seen some loss in market share? What does it stand at right now?
No, we stand at our market share. We may not have grown significantly, but the market share still remains the same. In the OTA space, it'd be about 22%.
Okay. What is discounting like? Because that we understand was around 3.1% of your gross booking revenue in Q1. And that's increased from levels of around, say, 2.9% in FY23. So what is it tracking at right now?
So if you compare it year on year, last year it was somewhere about 3.2%. Quarter on quarter, it was 3.3%. So there is a slight decrease, but I would say that it probably would hover around 3% in the long run as well.
All right, 2 questions before we let you go. Prashant, one was on the Ayodhya hotel. We understand that, bookings to Ayodhya have dropped over the last couple of months or so. So if you could give us a sense of how that business has panned out, and do you still intend to go ahead with that hotel? That's point number 1. And secondly, yeah, please go ahead.
So we do intend to go ahead with it. It is still going to take a couple of years for that hotel to come into fruition and life. It is going to be the closest 5-star available to the Ram Mandir, and the inventory is only going to be about 180 to 200 odd rooms.
But there has been a dip in footfalls there, right? There has been a dip in footfalls there, right? And bookings as well.
There has been a slight dip in the bookings and the footfalls over there. However, to fill up 180 room inventory, which is closest 5-star to the hotel, we do intend to bring some exclusivity where that hotel will only be exclusively available on eSmart Trip. We do not see any challenge to fill up 180 rooms on per night basis.
Okay, all right. Just a quick update with regards to your fundraising plans. You had plans of a QIP worth around 1,000 odd crores. Where does that stand?
So we have already taken the board approval to do the QIP of about 1,000 odd crores. We are still in talks with various people, and also as and when we take that plan to fruition, we will share the board resolution, and then we'll come on television and let you guys know.
All right. Always a pleasure speaking with you. Thank you, Prashant. Wish you good luck for the remainder of this year as well. Let's hope that GBR increases for you and you gain your market share once again this year, with the cost, being contained and you seeing better margins going ahead. Thank you for joining in. With that, we'll slip into a short break. As we do that, here's a quick programming note. Global investor, author and columnist Ruchir Sharma, in his latest book, has argued a more restrained government in India has been generating faster growth. He also talks about how India's stock market performance versus the rest of the world has been, but highlights a critical flaw in his latest book about what went wrong with capitalism. To know more, tune into CNBC-TV18 for a freewheeling chat on the global markets and the Indian economy later this evening at 6 p.m. Welcome back. The Nifty flitting between red and green, more green over the last 30 minutes or so. That's largely because of the IT pack. So it's a bit of a tug of war right now as you look at it from both the Nifty Bank as well as the Nifty IT. So the Nifty mildly in the green because it's the Nifty IT which is batting for the bulls. It's the mid caps which have seen a bit of pressure right now, though ameliorated from the lows out there as well. The broader markets would tell you more stocks in decline as against the number of stocks which are advancing by a factor of 2. What's interesting is in the second half of trade today, we will have the double expiry that plays out. We have the Nifty as well as the Nifty Bank options, weekly options expiring today because tomorrow, of course, is the holiday on account of Independence Day. We have, the 24,100 put pretty active on the Nifty and the 24,200 call, both of them pretty active. That's the broad range that the street is working with. And the no-brainer then would be to look at the 24,150 straddle, which is a call and a put together. The option writers are, paying 60 rupees premium for that, hoping for the range on the Nifty to be between 24,090 at the lower level to 24,210 at the upper level itself. For the Nifty Bank, however, it's a lot more interesting here because the 49,800 call and the 50,000 call have both been seeing a fair amount of writing. So the path upwards would be a little treacherous. But at the lower level, where we are right now, there is a fair amount of put writing as well. 49,700 put has a premium of almost 30 odd rupees, telling you around 49,650 thereabouts. We could see some support coming by. Two stocks I'm watching out for. Piramal Enterprises definitely going into F&O ban today with a 10% downtick that we're seeing. And GNFC is the other one, which is a likely candidate to enter F&O ban.
Okay, all right, Manglam. Well, that's the F&O setup. Pritesh Mehta of Yes Securities is here with us to tell us what he's strategizing today. Well, it's a Wednesday, Pritesh, and we have a midweek holiday tomorrow. What is your call today, considering that the markets seem to be quiet? The mid-caps have recovered from the day's low.
See, first of all, in last 2 weeks, we have been through a lot. First, we had fear-mongering headlines. Then the volatility in bond markets, declining global markets, and in comparison, relatively, Nifty has seen a less damage on a relative basis. Yes, we have come off the peak of 94,95,000 levels, but still we have not broken down. As I mentioned earlier, the list of stocks recording fresh lows on weekly, monthly basis, even on yearly basis, it is not getting bigger. So I think the breadth is not declining, the price is not coming off. It's a classic way of we are seeing that market is going to period of time consumption, and I think it is going to continue. 2900 would be the downside possibility, 24,900 would be the upside possibility. I think we are going to be stuck in this range for a last couple of weeks, in fact.
All right, and individual stocks, what are you looking at?
So yes, as you mentioned earlier, IT is doing well. So when we look, we have created a mid-cap IT index to track how this particular space is performing, and our customers index, within that space, something like InfoEdge is doing well. It is outperforming our mid-cap IT index. So from here on, we can see the stock going higher towards 7600. It has classic, bullish patterns. In fact, we can see bullish turtle breakout coming in after series of double top buys. So this stock is likely to do well. Another stock that we like is TVS Motors. This stock is now trying to surpass the peak of against the Nifty order ratio chart of March 2024, and again we have seen series of double top buys, bullish anchor columns, and ABC breakout. So I'm expecting a move towards 2800 levels in TVS Motors.
Okay, all right, Pritesh, we're going to let you go on that note. Thanks very much for joining in and speaking with us. So that's the technical call coming in. Well, for the markets, the IT index is going to go home with smart gains this week. In fact, it's going to be one of the best performers on a week-to-date basis in terms of a sectoral index. It's up around 1.4%. That's the Nifty IT index that I'm talking about. So done well on a week-to-date basis. We'll take a short break, but up next, a lot more on the markets. Stay tuned.
Welcome back. You're watching us here on Halftime Report. News that broke this morning, which was the Supreme Court allowing the state governments to collect past dues on mining from April 2005 in the form of royalty and tax. It, however, directs states not to levy interest or penalty in the past dues and collect them in a staggered manner over 12 years. This move, we understand, can be a big blow for miners, and we have a lot of these mining and metal stocks under pressure in today's trading session. Most impacted would, of course, be Tata Steel, which had accumulated contingent liabilities of close to around 17,000 crores as well. Could there be an impact on the cement space as well, is a question that we're trying to get an answer from Nitin Soni, who's the Senior Director, Head Natural Resources South and Southeast Asia, Fitch, joining in. Nitin, wanted your thoughts, one, on if you have any math on, what kind of impact this could have on cement companies, especially the ones that own limestone mines, and as a result of which, what's the kind of payments that they would have to make?
Yeah, thanks, Manglam, for having me on the show. I think this is definitely a negative news that now the Supreme Court has said that they will allow states to collect the levy and taxes retrospectively, but not before 2005. So as you rightly said, I think Tata Steel has accounted for a contingent liability of 17,000 crores. I think it will also certainly affect the other mining companies where they might have to pay, this retrospective levies and taxes on the mining activities they are doing in the state government. So I think we don't have the numbers at the moment. We'll have to, look at the exact numbers, how much they would need to pay. But I think it's fair to say that it's a negative news, and they would have to. I mean, we'll have to see. I mean, how the Supreme Court will react on the actual payment of these sums, because they might provide some flexibility on these payments if these are indeed a large sum of money over the period of time. I mean, immediate payment would obviously be quite credit negative for some of the smaller ones, especially.
Okay. But Nitin, in terms of cement companies, there is some opinion that the companies which have more exposure to Tamil Nadu will probably get impacted more. What is your sense in terms of which are the cement companies that could probably see some kind of impact, and if you could quantify it for us?
So in our portfolio, we don't rate the smaller cement companies. We have rating on the UltraTech cement, which is highly rated at investment grade ratings. I don't think they will have a significant impact due to this, given their large size and scale. But certainly some of the smaller cement companies, which we don't directly rate, they might have to pay a significant sum of money. Sorry, we don't have the numbers on the smaller names.
Just final question before we let you go. Would you have any numbers on what the per ton impact could be on this? And because you track UltraTech, do you think this would change the UltraTech India Cement deal modalities?
I don't believe that it will have any impact on the deal, but I think it's tough to say the impact on per ton basis, because it would vary company to company. Because this is now a retrospective impact on the companies, right? Prospectively, yes, I think all these companies would have to pay higher levies and taxes, so their EBITDA margins will come down. I mean, the cement sector, as we know, it has consolidated with a large market share between UltraTech and Adani. So in there, the pricing power could also be affected by this, the higher levies and taxes.
Okay, exactly. The pricing power is what, I wanted to actually quiz you on in terms of the movement of cement prices post this kind of uncertainty. What do you expect it to probably be? And firstly, just backtracking a little bit, by when do you expect some kind of clarity or certainty to emerge in an issue such as this?
I think it will take time to for clarity to emerge on this aspect, because I think that as you know, the central government was in favor of doing only a prospective levies and taxes, while the Supreme Court has said no to it. So the clarity on the actual payment, the terms of these payments, over how many years they would allow to be paid, will only come, I think, in the later part. But I think the pricing power, I mean, there's still a fair bit of competition in the cement sector, especially in the regional states where, the smaller cement companies tend to create competition, even for the larger ones like UltraTech and Adani. So I think, this further levies and taxes would kind of dent a bit on the pricing power. But overall, I think the cement sector is in a good situation where the industry has now consolidated.
Got it. Take that point. Just on a lighter note, Nitin, wherever he goes, there are these retrospective tax issues that are coming by. Earlier, he would track the telecom space, and now this. What's happening here, man?
I think the retrospective laws are following me.
It just means more work for you, and that's not a bad thing. But thanks very much, Nitin, for joining in and taking us through that news. We'll touch base with you when there is, obviously, this is an evolving story, and we'll get more clarity as we go on. We'll take a short break, but here's a quick programming note. Global investor, author and columnist Ruchir Sharma, in his latest book, argues how a more restrained government in India has been generating faster growth. He also talks about India's stock market performance versus the rest of the world, but highlights a critical flaw in his latest book, What Went Wrong with Capitalism. To know more, tune into CNBC-TV18 for a freewheeling chat on global markets and the Indian economy later this evening at 6 p.m. Welcome back. Well, recovery for the mid-cap index, so just about lower by around 200 odd points. We have the bank Nifty also which is just about trading with a little bit of a negative bias. You'd have to say that there's definitely a good recovery which has taken place. IT seems to be the flavor of the week. TCS, that one is up around 2.5% at this point. It's gained around 1.7% this week. HCLTech also doing well, so up around 1.8% for that particular counter. Infosys giving it company, as well as LTI Mindtree. So that particular section seems to be really gaining some amount of traction and has been for the entire week. Separately, Apollo Hospitals, good margin improvement is what they're indicating. So that stock is one of the top gainers on the Nifty as well. But I'm watching Divi's Labs because Kotak came out with a report on Divi's. They have a sell and they have a target price of 3,600. According to them, Entresto, which is basically a drug by Novartis, which is used for heart failure, and is one of Divi's largest drugs in its CDMO portfolio, which is contract drug and manufacturing. There could be a downside risk to Divi's on account of possible generic competition entering into Entresto earlier than anticipated, because there was a US District Court ruling which ruled against blocking MSN, which is another pharma company's generic entry of Entresto. So basically, they are more favorable towards a generic company entering into this particular segment. Now, Kotak has not factored any generic entry before second half of FY26. So there's a possibility it could happen earlier than that. According to them, the CDMO contract that Novartis has with Divi's on Entresto contributed around 8% of total sales and 19% of their CDMO sales in FY24. So that's how important a drug it is. And they are keeping the estimates unchanged for Divi's at this point in time. But the generic entry looks imminent, and it could lead to a 10% plus downside risk in the FY26, FY27 estimated EPS for Divi's. In any case, they say that the valuations are extremely expensive. So as you can see, Divi's is down around 4% on the back of this fear that there could be more competition in one of their key drugs which they manufacture. Well, on that note, it's a wrap on Halftime Report. Business Natural take all the action, folks.